And now we have our first panel of the day. We have RWAs and Stablecoins in DeFi, Opportunities and Challenges. And on the panel, we have Anthony from Coinbase Institutional, Luca from M0 Labs. We have Benjamin from Qidao, and Assad from Centrifuge. And moderating the panel, we have Ivan from Aragon. Let's go.
Awesome. Okay, so hey everyone. Thanks for tuning in and for being here. Hopefully we'll have less technical issues now that we are all here IRL. I'm joined today by Assad from Centrifuge, Pablo from Qidao, Luca from M0 Labs, and Anthony from Coinbase. We're going to talk about real-world assets and stablecoins and how all that plays together. So to just get us warmed up, why are real-world assets relevant for stablecoins? I mean, are they, and why? Anyone can jump in.
I think the answer is absolutely yes, right? Centrifuge, the first protocol to kind of bring real-world assets on chain, first to work with a stablecoin. I think the simple answer is that real-world assets represent one of the largest market opportunities. So if you believe a stablecoin is kind of this financial intermediary of the new age that can kind of connect collateral and kind of lenders and liquidity, then obviously real-world assets, tokenization, the whole capital markets kind of ecosystem becomes naturally one of the best, I think, ways to build demand for your stablecoin, find collateral for your stablecoin, and ultimately spread and kind of integrate economic value. So to me, the answer is absolutely obvious.
Hey, so I'm Benjamin, by the way. The other one, Paul's my co-founder, but no problem.
Sorry about that.
So yeah, I come.
You guys are brothers. You look alike.
We're brothers, so it's okay. Yeah, so I come from a decentralized stablecoin, and I really think MakerDAO proved that you need real-world assets as a part of your stablecoin ecosystem. And that's because without real-world assets, the only yield source in crypto is usage, right? If you go back, where does all the revenue come from? Is usage. It could be transaction fees. It could be interest rates, anything like this. And in a bear market, you don't have any of that because nobody wants to leverage, nobody wants to transact on Ethereum. And so as a stablecoin, that becomes an existential threat, right? And so what MakerDAO does is when it's a bear market, they kind of switch more to real world assets. So minting through the PSM, getting that minimum yield that comes from outside of crypto. And that kind of pendulum between the two is very important for any CDP to kind of master.
So first of all, I think the term real world asset is the most stupid term we could ever imagine.
And stablecoins, right? And
yeah. But let's put that aside. I think ultimately, this stable coins, or let's say money, it's some sort of derivative product of something. It's like in a bank is actually liability of an asset side. You have dollar-denominated stablecoin. You need to have dollar-denominated assets. Otherwise, you're not going to go anywhere. Otherwise, there is either a lot of risk and friction or no adoption. So ultimately, the two things go in sync. So if we actually want to create a stablecoin that is pegged around the dollar, because ultimately the dollar is still the unit of reference of the world, you need to have an infrastructure that is able to absorb assets that are dollar denominated. Otherwise, scalability is pretty much impossible.
We do have to say, though, that Liquidity was able to have a stablecoin without that kind of connection to the dollar, but they function on redemption, and I think people don't like that, so it's hard to scale. But it is possible, just maybe not at a large scale.
It's not possible through the cycle. In bull market, everything is possible, but Liquidity through the cycle is not going to make it.
Yeah, I mean, we're trying to build things that would, last for generations, right? Yesterday, someone was saying about Curve's inflation schedule is 300 years, right? So it's, I think being a slave to the cycle is not really something that we're shooting for here. So you mentioned Maker, there it's a basket. So I agree, real world assets probably, cash in a bank is still a real world asset, and that's what backs Tether and arguably Tether and USDC. Yeah, and a bunch of other projects in the space. But would other types of meat space asset always be like a minority within the collateral basket, or would they like expand to become like a sizable portion of the collateral basket? What are your guys' thoughts?
Always a minority. You're not going to be able to take the liquidity profile of hard assets and make them as liquid instruments like treasuries, T-bills, or dollars, ever. There will always be a gap. You'll get there, but at some point, somebody has to take the underlying out when no one wants to trade the liquid wrapper. So the market has to have the infrastructure and the market structure around it so that there's another buyer for that underlying, right? So you're always going to have that last mile of illiquidity risk.
Yeah, I mean, I fully agree. I also think that we should learn from what has been done in the past. I think banks are ultimately the best maturity transformation machines there is, but in order to absorb long-dated illiquid assets, they need to have significant buffers to do that. Like if you look at Maker, maybe some of you guys know, I spent a lot of time in the Maker ecosystem, so if you look at Maker, their so-called surplus buffer that can absorb that, it's so tiny. Like if you look at a bank, probably that surplus buffer that absorbs that, also that maturity transformation and credit risk is probably, 10%, call it 10, 15% of the risk-weighted assets. So there is a lot of friction, so I fully agree. So you have to go either very liquid or less liquid, but also very inefficient from a capital perspective. There's no free lunch.
The question was, will real-world assets be a large portion of the basket of stablecoins?
Yeah, like would they become at any point like a large portion of the collateral backing stablecoins?
I mean, right now they are the largest portion
Well,
of
like,
the...
kind of like cash at a bank, right? Like,
Right.
I mean, like other more, let's say, diversified types of assets. Like we've heard stuff around, real estate. Someone from Centrifuge team was saying like, oh, you can like have a Centrifuge pool backed by like music royalties, right? Would these more exotic things become?
Yeah, I wouldn't recommend that for a stablecoin, to be clear, but you can. I guess in theory you can do anything you want, right?
Well,
I think
go
you've got to I think we have to like define what we're talking about though. So, like I can go on my brokerage account and I can buy a REIT, and it trades, and the underlying is real estate, right? But like I'm part of the secondary market structure. I'm part of the supply demand within that exchange, and I'm never ever going to take the underlying out of that wrapper, right? If we're talking about stablecoins in terms of their use on public rails, on chain, and maybe as a trading pair, like I think like maybe this becomes interesting when we go, can you take a traditional piece of real estate, wrap it in a registered wrapper, put it on chain, and then it trades as a trading pair, like in that market. And so the structure will never allow you to take the underlying, but people understand that, and there's still a market that's making price discovery around the value of that real estate. That becomes interesting, and it's possible to have an asset on chain that's part of the ecosystem that could be thought of as a stablecoin, but it's not a stablecoin. It's real estate, right? And so at some point, when you're saying, can we put real-world assets inside of a stablecoin, right? You've got to go, it's no longer a stablecoin, and now it's a different exposure, right? It's whatever that underlying is. And so the price of that asset has to change. So if you're saying I'm going to have a fixed peg stablecoin that will always be worth $1, but backed by a bunch of real estate, like you're going to be hit with that liquidity gap at some point because the market it's not really that, right? I think we have to be clear on exactly what the structures are.
Yeah, and I think we could add stuff like that in decentralized stablecoins as collateral, maybe towards what you were kind of talking about. But then you have to think about the risk from the perspective of a stablecoin holder. So like for us, if I were to add a bunch of houses in Miami as collateral for then potentially the market premium for my stablecoin is going to go up a lot because people are going to see liquidations as less viable or maybe harder to accomplish. And so the pools are going to be, instead of 10% APR, 50% APR. And that has a lot of effect on how much we need to charge on our unit economics. And maybe we cannot charge enough in the loans against these real world assets to make up for the risk that they create for the stablecoin holders.
It's interesting that we here are thinking of like real estate as more risky than Ethereum and Bitcoin as collateral. I think anyone outside of
Well, it's not the collateral, right? It's the computation. It's not programmable.
Yeah.
I definitely think real estate might be, less risky. I don't know. Who knows? I like ETH, but it's hard to program it.
Can we? Sorry.
It's a liquid.
Yeah. Like, can we? Like, I mean, does any of you guys can you run us through like how would actually liquidation of a pool or like collateral that's backed by, let's say, a rate, how would that play out? Like, have you guys have an idea of like, how would the unwinding of that asset as collateral go through?
I mean, ultimately, if you have real world assets backing a stable coin and you enter into like a liquidity situation where you need to then access cash, right, and return it to holders on chain, most of the real world assets that people are using as collateral for stable coins today are the most liquid assets in the world, right? Now, of course, there is like the lag between it's a different system, it trades off chain versus on chain environments. I think, but today the answer is pretty simple. You go into off chain markets and kind of traditional brokerages environments and you access liquidity that way, right? The world that I think we need to get to, which will make it more interesting in the future, is where you start having more of an on-chain representation of those type of markets existing on-chain. And so you actually have, whatever your underlying collateral is, trading in an on-chain capital market that actually has real buyers and sellers. And then that starts to create some more of the composability. Because I do think it's really tough to say that there is no universal answer for all of this. And things like Bitcoin and ETH, despite being incredibly illiquid in their own way, are also incredibly useful for stablecoins because they are fully integrated in DeFi networks, right? So there's always this kind of capital markets efficiency that you need to create that is always difficult to do in the world where you're trying to get DeFi kind of one-to-one with an off-chain asset. But I also think that's the world that's coming, and that's kind of what we'll start to see more of in the future.
Yeah, and I spent probably too long in traditional finance, but I think there has some value in it. So the reason why, for example, I don't like the term real-world assets is that we have been trading mortgages on Bloomberg for many years. I never heard of Bloomberg guys in mortgages in my life. And I think we have just been doing it through a structure. And now we're just thinking about changing the structure. So it's all about doing the right structure. So like, ultimately what we're doing is on-chain securitization. So we're creating a structure off-chain, and we are just creating, I think was the original idea of centrifuge as well, like having seniors and juniors. And if you have a good structure, we can learn a lot on how you manage the assets in the off-chain world, because you have RMBSs, you have CMBSs, they go bust, but sometimes they're also, like, I think probably the vast majority of the mortgage market in the world is actually trading through securitization wholesale markets. So you can learn a lot about that. Now, the only thing we're saying is, wait a second, but this was wholesale market for large investors, but the monopoly of printing money for retail was of the banks. We have stable coins backed by liquid assets. You go to a bank for a mortgage, the bank is not giving you someone else's money. The bank is minting money out of thin air, taking the appraisal of your house. So they have a monopoly on deposits. They're facilitating. They're making a huge spread because they don't give you any money. So now what we're trying to say is that let's connect these two things. Let's take the off-chain securitization-like infrastructure to keep the assets. Hopefully this stuff will become better and better with time. Let's create the minting engine that we can monitor and observe on-chain. Let's get rid of the banks. And that's the connection. It's complicated. That's why most of the successful centralized stablecoin issuers now are on top of banks. If you take Circle is just like an overlay on top of a bank. But like, I think the holy grail is connecting the infrastructure that is storing the assets off chain to like the minting engine on chain. That's what we're trying to do also at M0. And I don't want to advertise what we're trying to do at all, but I think we can learn a lot from the way we have been managing the assets in the off-chain world, because this is not new. This is not a new problem.
I love the fact that you brought securitization, because Bitcoin came out of like a financial crisis that was brought through tranching and railing risk specifically on mortgages. And there is the phrase of like don't trust, verify, right? Which is sort of like a guiding principle for a lot of people in the space. So with that bringing more traditional, like, and I know real world asset is not the greatest phrase, but it's like things that you don't necessarily have a direct price feed on chain, right? There is a lot of trust, like appraisers, auditors, et cetera, So how does that reliance on, traditional, often heavily regulated intermediaries that have systematically failed us, how does that match with the ethos of don't trust, verify?
So if you think about, I'll just share like what I'm seeing across the industry and kind of how we're supporting our clients, many of which are in the room, so thank you all for being partners. From Coinbase's perspective, we're an infrastructure provider, and so you can use us for custody, for wallet, pay SDKs, blockchain, a whole bunch of different things, on-ramp to bring your USDC and other assets into on-chain. So we're a bridge, and you can build on it. And lots of people are building really cool stuff. And all the cool stuff that's being built are, in terms of real-world assets and tokenization, are these projects that are looking to do just this thing, which is taking traditional real-world exposures, right, and the legal construct of it, the physical construct of it, put it into a vehicle, and then figure out how to tool that vehicle so it can now be represented on-chain in a digital format. And we're in this world right now where that's like a Web 2 and a Web 3 thing, where you still have to have a house with an appraiser, with an escrow, with an agent verifying the value. You still need a fund administrator striking a NAV for your funds. You still need an escrow agent in the middle between three parties to manage collateral for an event that happens. Like, all that stuff is still very much required in the process of taking off-chain exposure and bringing it on-chain. And so like the holy grail for the industry is to figure out how do we take these traditionally physical contracts and represent them digitally on chain and get rid of all those intermediaries. And I know Centrifuge is doing a lot of this work here to try and figure out how do you repackage that complex of providers who allow you to have trust today in Web 2. So a lot of the trust in Web 2, it comes from like the institutional build out of verified agents who do those things for you to help you build trust and then build a business around it. Does it go away when it's fully on chain? For real hard assets, there's a point where it can for liquid markets, right, where people just want to speculate and trade the derivative of the asset. But there's also a point where those participants in the market structure are going to want to know that there's actually something backing it if it's a real world asset. And at that point, you absolutely are going to still need somebody on the ground to go and knock on the door to make sure the house is there, right? And so sometimes that could be like satellite imagery, right, that gets digitized and piped in to maybe IPFS, right? Sometimes that could be traditional fund administrators who are now digitally able to represent those assets or the verification of it on chain. And so that verification data feed gets piped into the asset on chain as well. And so I think it's going to be this evolution of the service providers, the agents who are there verifying the stuff, will also come like join us on this tech stack, right? And they'll get retooled appropriately so that we can just digitize what they do, and so it's not a Web 2 operation. Hope that's helpful.
Yeah, right on. So at Centrifuge, like, how are you tackling this today at Centrifuge? Like that reliance on these intermediaries?
Yeah, I mean, I think for us, the whole belief is that the trust but verify is really like the opportunity to build kind of better traditional financial market infrastructure. So I thought Anthony gave a great answer, right? We really do believe in retooling kind of the way that traditional finance structures have been built. You mentioned 08, like the real problem in 08, and there was many problems, of course, but you had money markets tied to collateral markets, tied to derivative markets, and no one knew who was where, what was owed to what, and ultimately it all blew up, and they couldn't really unravel the whole thing, and the central banks would step in, and obviously Bitcoin rose on the back of that, right? But the real issue was actually, in my opinion, financial infrastructure and the way the market was structured and the complete opacity you had and kind of built into the market very naturally. So at Centrifuge, our whole goal is to actually run like an on-chain portfolio on-chain, right? So it's not just trying to create opportunities for tokenized assets to trade on blockchain rails, but actually do a lot of work to take a fund administrator and transform the way they interact with the fund so that their kind of the outputs are being created on chain in a more transparent way. So very simply, like what we're trying to do is really, if I had to like really describe it, is we're trying to tokenize every aspect of a portfolio. The transactions, the cash, the securities holdings, take off-chain accounts from custodians and bank accounts, represent that on-chain, and do all the kind of the hard, gritty, unsexy work to enable kind of new asset managers and intermediaries to operate kind of in a different way, right? We think that comes with cost efficiencies, but ultimately transparency, I think, is the biggest kind of long-run efficiency.
And simple, right? So a fund administrator who strikes a NAV, today they put it in their own database, right? Tomorrow we want them to put it on chain. So it's not like they're doing much different, right? You're just saying like, just don't put the data in your own silo, put it here in this wrapper so that we can ingest it in this process, right?
And the future for that, tying in some of the early questions too, is like decentralized stablecoins are built on these really foundationally programmable kind of automated structures. And if you have now an on-chain structure that represents kind of that off-chain world more fluidly on-chain, you can have this really dynamic kind of linkage between decentralized stablecoins and the way they interact with these, real-world assets, right? These off-chain structures in a way that I think is way more automated and dynamic and actually like kind of creates the future that we're all hoping for.
I do want to say though, no matter what we do, it's not Bitcoin, right? It's not Ethereum, right? It's not. You cannot trust it. You can try to verify it, but I think in this long journey of opening up financial markets across the world, outside of Europe, outside of America, outside of China, we're going to have a lot of FTXs. We're going to have a lot of people that say that you should trust them, that they're tokenizing real estate, or they're tokenizing real world assets, and they're going to fail. People are going to lose money, and that's just going to be part of the process. But what I think that these tokenization companies bring is not trust in the financial market. It's going to be the same thing. The difference is access. Because today, if I'm a European family office and I want to invest in UAE bonds, or I want to invest in American T-bills, there's a lot of logistics around that. You need to create extra companies. You need to have bank accounts in different banks. Maybe if I'm from Chile, so if I have a Chilean family office and I want to buy Hong Kong dollar bonds, it's very difficult. So access is going to be, I think, the big innovation here. But let's not say it's trust and then get slapped in the face when we realize that you cannot have the same trust in real world assets on chain that you do with like Bitcoin and Ethereum.
Yeah, but I think I want to abstract. I think maybe I am a bit too nerdy here, but
I don't think you can be too nerdy in crypto.
I think I can, but it's like gold, for example, is also like. I love Bitcoins. I think it's the best representation of digital gold we have, way more efficient. You can trust the ownership of Bitcoin, yes. You can trust the value of Bitcoin, it depends, right? If you're measuring it in dollars, there is a lot of volatility. And volatility can slap you. I think that there is a lot of volatility in credit. You just don't see it. It's like a earthquake. It's fine until it's not fine, then it's too late. I think that what was great of stable coins, of money in general, was like barter. If I need to give you like a cow, you have to give me something in exchange. We need to do price discovery all the time. It takes a lot of time to transact and to know you. It's impossible. Like the idea of money is this stuff, it's so over-collateralized by army, by gold, by credit, by houses, whatever, that you can kind of trust it. Fine, don't spend time. Let's do business. And I think this is very powerful. Now, I think what we're trying to do here, all of us, I believe, like we're trying to create a system that is very efficient in creating this mismatch between the value and the transaction facility. And we're trying to bring as many assets as possible into this pool. Like Bitcoin, it's easy. As you said, I fully agree. Or Ethereum is programmable. It's verifiable, but it's very volatile. So what can you do? So we're all trying to expand this collateral basket to bring more stuff into the funnel. And it's a process. It's going to take a lot of time. This is stuff that banks have done for a long time. They're saying, we will do everything. So you can regulate us. We will have 1,000 trillion people, massive equity buffers, very inefficient, cumbersome. Definitely not the end state. But I think that's what we're trying to do. I think we're trying to bring more assets. But my belief, and it's something that I know that today there will be people that are doing something that I don't necessarily believe in this the long list of developers and innovators in this space, is we never have to forget this idea that stable coins are great vehicles to transact, meaning that they are cheap sources of leverage. you need to give the users of stablecoins stability in exchange. You cannot use it as a way to pump the bull market, because when things go up, you can bring everything in because volatility is not going to slap you. It always goes in one direction. I think that's something we should be careful, because we've seen it in the past. Because when things turn, then it's not stable anymore.
And this I think is definitely better than banks, because if you look at a bank, it's regulated, and by this I mean what you guys are building, like centralized, use cases on chain. I think it's better than a bank because a bank is regulated by one country, right? Like if you're using a PayPal USD, that's like America, right? Like that's your risk. But if you have these real-world asset companies from all around the globe, who regulates it is the market, because we will have them blow up, some of them, right? There will be a lot of like drama around it, and in a long enough time frame, the people that are going to regulate it is the money. Like people are going to eventually say, this is a good way of doing things. This is a good way of doing things, and we don't have to rely perhaps on Elizabeth Warren in the U.S. or Gary Gensler, right? We can rely on everybody in the world to regulate it, and that's why I think what these guys are building is pretty cool.
Yeah, I also love the evolutionary perspective of like some shit's gonna blow up, but
It has to. I mean,
yeah, and it's like it would be painful for the people that are exposed to it, but like overall, that's almost inevitable step that we have to go through.
Yeah, I think I want to go back to your point, which if I kind of interpret what you're saying is you're saying we need different banks, or we want to replace the banks, or maybe we want to decentralize the banks in a way that we give any asset holder the ability to
I think we can decompose them and evolve them better than what they are now. I think they are inefficient construct. Yeah.
Maybe I'll just pitch you one here. Talk about what you're doing, because it's interesting.
So what
You've been silenced.
it's the banks.
Yeah. I mean, what we're trying to do, like in a nutshell, ultimately is we are trying to create a governance framework that is actually making very transparent rules that what you can actually bring on chain as a proof of collateral to mint stable coins. Like, that we have had a lot of, so we went from the idea of fiat-backed stable coins, which is pretty much an overlay on top of a bank. You have cash that is created by a bank, you put it in a vault, in an account, and then you have a token, you can trade the token. Then we have had an evolution of asset-backed stable coins. Like you don't need the cash, you just put like a bond, there is gonna be a haircut, you get a token, what the guys at Mountain are doing, for example, and the token may actually be yield-bearing. We're trying to do something else. Like you have the governance that decides that, so we can have 1,000 mountains come and actually have common rules, common standards to bring collateral and mint one stable coin. We don't need 50 different branded stable coins. We don't have a JP Morgan dollar, a USDC dollar, USBC dollar, etc. So we're trying to create standards, tools, and governance so that anyone knows the rules to bring a proof of a collateral and can decide how this collateral can be transformed into a digital dollar, and this digital dollar is the same. So ultimately, because we believe that, to your point, like there are a lot of dependencies, so ultimate transparency is not reachable, but decentralization is a good value. So instead of having one issuer, we should have 100 issuers, similar rules, no fractionalizing liquidity, 100 collateral providers, 100 collateral storages instead of one, so that we can decompose transparency and make the system more resilient.
How do you propose the choosing of these standards and the upgradability of these standards?
I think transparency, like at M0, we have created a foundation. The foundation is supposed to be a think tank that is actually publishing rules, regulations, not only about the standards of the collateral, not only about the parameterization of the system, but also about the type of legal constructs, the type of business standards that should keep evolving, and governance of the M0 ecosystem should vote for that. Our governance is not a DAO. I mean, I spent a lot of time in DAOs. I think DAOs are great for certain things, but I don't believe in liquid monetary policy where everybody decides. I think that we should have resembles more like a consortium than a DAO. But this is an evolution. But I think we want to start simple. So I think starting with bringing music royalties as a backing of stablecoins, you're starting from the most difficult asset in the world. Starting with emerging market short-term small ticket credit to back stablecoin is a beautiful idea. But as soon as you open that venue, I live in Brazil. As soon as you open that venue in Brazil, I can assure you there are going to be people that are just thinking about how to game the system and bring the shittiest possible collateral there and get the money and run away. So I think you need to start very simple and then evolve the standards with time.
I think Tether's an interesting example. Based on what they've disclosed, right, it's mostly commercial paper and T-bills and other things. But there's a little slug of loans in there, and there's a little slug of some other stuff in there. And so, to your point about like starting with high quality underlying liquid underlying is really important. Once you reach scale as a stablecoin, you can probably start to take on that additional illiquidity risk, and the market will not penalize you for it. But at some point, when you start to take on that illiquidity risk or the bad asset risk and others, that's going to get priced into the product itself and how the market consumes it. And so it's important to bring standards around the underlying, which is if we want to unlock more of this trapped capital effectively in real assets in our traditional landscape and bring it on chain, there's going to be a process to that. And one of the functional pieces of that process is how do we get standardized ways of understanding what's actually there. Right? And it's going to take most institutions a while to like retool themselves to really bring their data process on chain. That's, I don't know, I won't put a timeline out there, but it'll be a while.
Actually, Benjamin, you mentioned that, potential, and touching on, Anthony, you're touching on something that Benjamin mentioned earlier, that like potentially there would be a requirement for higher risk, like higher yield because of perceived higher risk. Like, is this something that we've seen already, or like we've observed?
100%. Like, if you look at the stable coins that add like really bad assets, you go to Curve, you go to Aerodrome, you go to any DEX, the APRs are higher because people, like only the degens go and like actually like farm those LPs. And so from our point of view, we try to add assets that are not too risky because then we can actually make money, right? Because you cannot charge infinite amount of money for loans. People will at some point just not want to pay it. And so you need to have some sort of balance. And maybe having different stable coins, like Reserve Protocol, they have like a ton of stable coins. And then you kind of look at the collateral and say, okay, that's like my risk profile. I like that too, because there is room for degens to like decide I want to do that.
We had an opening presentation where it was like, oh yeah, like most of the stable coins out there today are centralized, and a lot of the DAOs have not delivered on their promise. Luca, you mentioned like on-chain governance, but not a DAO. Like, can you unpack like is it more like role-based decision making? Like, who are the stakeholders that you're thinking, and like how are different stakeholders involved in like this sort of decision-making process, so it can indeed become a like capture-resistant system, right? Like,
yeah, and I think what the point, I mean, we started from that ethos of, I mean, we are thinking about the censorship-resistant system, but then we actually have the main settlement assets in the system that have a white blacklisting functionality in the hands of regulators. So it's not censorship resistant at all. And I think it's not good enough. So, for example, when we developed the M0 concept that we launched the white paper a couple of weeks ago, first of all, we said, okay, what we're actually doing is not even a stable coin. It's some sort of like digital over-collateralized representation of good value. So we actually called it M, like a basic of money, raw material. The stability is just a functionality. Stability is a short-term functionality. Like, everything is stable then until it's not. Terra was very stable for 99.99% of the time. It was not solvent, but it's a different story. But they were optimizing over-indexing on stability. So I think that, so we developed an asset that doesn't have blacklisting functionality. There is no one that can switch it off. But I think going back to your, this is important for us, and it's something that actually can decentralize with time, because we think we need to have more and more people that actually providing settlement assets on chain in dollarized form. It's crucial for our system, especially now that we're moving into the rollup era or the eigenlayer era. On governance, in very simple terms, like we think that decentralized governance is pretty good to take very important decisions. We have it. You know, we live in the shareholders economy. We have pretty much we have decentralized governance already in the capitalistic system, but it's probably not good to have like liquid democracy that discusses about everything, about daily management of stuff. It's complicated. It's a theater. Then it becomes the tyranny of structurelessness. Like, you know, there are like underlying groups that actually decide the move that, you know, they orchestrate the things. So in the M0 system, very pragmatically, M0 is a system where the output is permissionless, but is a system where actors come and do specific roles. So you need collateral storage parties, you need minters that come and interact with the minting engine, you need validators that they can cross-validate transactions and mints. So what the governance does, it's simply approving parties to come and do stuff for the system. So we would expect probably 10 rules, 10 ruling per year, not like 10 per epoch. And plus that's some sort of parameterization, but governance is truly minimized. And the guys, I mean, Greg, Antonina, the people in our team, they spent a lot of time thinking about a good governance system that is minimized on important decisions. The ambition, again, is to have simple governance that decentralizes with time. So, for example, we have a system that progressively dilutes whales that don't participate in ruling the system. So they might keep the economic benefit, but they will lose voting control. So we're actually creating a system in governance that is simple, incentivizes decentralization, doesn't spend too much time in micro decisions, and is resistant to regulatory capture or whale capture of some sort. That's what we are aiming for. And our governance module will be open source, so anyone can build on that.
I think you guys should also look at what decentralized stablecoins have done for the creation of standards, right? Because decentralized stablecoins also have meta governance in a sort of way. Like if you look at Liquidity, QiDao, MakerDAO, maybe Abracadabra to some extent, Inverse, right? There's all these CDPs. We actually do have some sort of like standard building via the market, because the market is God. Like there's nothing better than people voting with their money. If you have a bad stablecoin, people will leave. If you have a bad company, people won't invest. And I think that's amazing. And look at Liquidity. Like Liquidity, they had their V1, it was amazing, but then they have no ability to react to the market like MakerDAO does. So MakerDAO increases the cost of loans depending on the federal funds rate. So Liquidity is like moving closer to that in their own values, right? Like without having governance. And at QiDao, we're also kind of looking what everybody else is doing and trying to improve. And the reason we're trying to improve is because people are voting with their money. If you don't improve, if you're just forking Liquidity V1, like nobody's going to put money, right? Like you have to really keep going. And I think that market way of having governance is going to be better than anything else.
So closing statement, 5 years from now, will we have more decentralized stablecoins or more real-world assets backing them, percentage-wise?
I mean, I think that decentralized stablecoins are where all the experimentation has been taking place. I think that trend will continue, right? I think we'll see variations of stablecoins in the market, but I think decentralized stablecoins and real-world assets will continue to be good friends going forward, in my opinion.
Yeah, I think centralized stablecoins will continue to dominate, and I really look forward to seeing better jurisdictions like the Gulf countries or maybe like Hong Kong have a bigger role in this like save on the blockchain or remittances, all that stuff. I think they'll have a huge role to play, and yeah, it will definitely eclipse decentralized stablecoins.
I mean, I always joke that I think we're not in future guessing game. Like here as builders, we're in the future making game. So it's what we make of the future. I think the stablecoin market is going to probably 10x in the next 5 years. And I think if 90% of that market is going to be controlled by one company, we are in a pretty bad future. So hopefully that's not the future we're going to be in.
I think you're going to have both, but decentralized stablecoins are going to dominate most of it, just because they are a representation of fiat traditionally. But ultimately, the goal is to not hold fiat, and the goal is to have like multi-asset portfolio construction on chain, so that us as individuals cannot be inflated away from fiat systems. So, I'm pretty bullish the RWAs backing stablecoins narrative long term, but ultimately I don't consider them stablecoins.
Thank you guys so much for this panel. I certainly learned a lot, and I hope everyone else did as well.
Thank you.